I like MetLife as a business. They make a lot of money. It's an insurance company. They're very well known for life insurance. And when we look at these businesses, they tend to be boring, but they tend to make a lot of money. So over time, they are a positive like stock to have. It's in this case here, MetLife is up 66%. And if I add a 2.5% dividend, and I compound that dividend, we're probably adding 15% on top of 66, making it probably closer to 80% return. That's very good from a well respected company. I'll take that any day of the week because I have some really exciting stocks. But some of those exciting stocks, they go up really fast and they fall really fast at times. So, but these like MetLife, this is like a blue chip stock, very reliable, more Dow based. So it's not a bad stock to consider because we've been in such a, uh, bull market for 2 years. Is it going to continue? Maybe, but a quick reminder that, going into 2023, we were expecting a recession. It never came. So the market really rallied because it was like a surprise. Oh man, we're not going to have a recession. We're not going to have, just no GDP growth. Okay, cool. Stocks rallied. So then going into 2024, the Fed was supposed to cut rates very aggressively because inflation was being tamed. Interest rates were quite high. There was a concern that, hey, they're going to slow down the economy into recession. Well, the rate cuts didn't happen, not 7 of them, which were the estimation at the very beginning of 2024. That surprise caused the market to rally. Now we're going into 2025 with an optimistic point of view where GDP growth is supposed to be 2.4% or something. There's a pretty good probability that there is negative surprises in 2025. So we can have a sell-off in 2025 that could be a good one. And owning a stock like MetLife might look like a really good move before we have the sell-off. Because in times like that, MetLife will have policies with its customers and they'll have a relationship with that customer for 50 years. And that customer will pay their premiums so they can have their life insurance so that, if they pass away, their families are taken care of. And, why we buy life insurance or whatever types of life insurance MetLife is selling. They also do dental insurance and a variety of products. They also sell annuities. So all those things work in a bad economy. And MetLife tends to hold its value when the markets go into bear markets. So it's a good idea right now to look at MetLife for me and think about, okay, well, this one here might be a good safe stock to buy into, but let me value it and see, is it a stock worth having? So let's take a look at it. So first thing that I like is it has a super low PE, 9.36. That's really low. Dividend 2.56, pretty decent dividend. Analysts believe it's a strong buy and it's discounted by 5%. Now, when we look at their revenue, they have revenue growth. It's a little bit cyclical. You have some ups and downs, but they do have revenue growth. When we look at the quarterly, especially, man, look at that, 16%. This is a pretty big company, right? 18 billion in revenue. So that looks really good. I like what I'm seeing there. Good revenue growth means the business is healthy. It's adding customers. It's getting new customers. The customers that already buy their annuities and stuff are buying more. And look at their cash flow. Beautiful growth in cash flow from 2020 to 2023 and into the trailing 12 months. Just nice upward slope. Beautiful data. I love upward sloping data like this because it makes me feel confident that I'm going to be able to forecast their free cash flow accurately. So I really like their PE. I really like their free cash flow. They're growing their top line revenue. Their margin on cash flow, 21%. Not a lot of businesses are going to look like this. To have a margin of 21% shows that for every $100 of revenue, you get to keep $21 of cash. Very, very strong metric. All right, we looked at that. Let's look at the forecast that analysts have out there. Now, the best case scenario, you're not going to hit a home run. It's not going to be a multi-bagger overnight. $99, just going to go up a little bit. Worst case scenario, not too bad. Nice safe stock. Look at that. That's why we get an average price discount of 5%. Is 13 analysts are putting their price targets out there, and so it's a stock that they believe in, and it's pretty predictable. When we look at their earnings per share, revenue is going to continue to grow nicely. Okay, good. Single digit, mid-single digits. but their earnings per share growth is really going to expand in 2025. It's a really nice expansion of 17%. So very good. And that's what's going to drive down that forward PE. So that looks excellent to me. So Met is looking good. Now let me put all those metrics into my evaluation. And my evaluation is I took all the free cash flow that we have. I put together a free cash flow forecast that includes the first 4 years and then a terminal value, all cash flows after year 4. And the cash is so darn high, it creates a huge number. It creates a very large intrinsic value number. I add cash and take away debt. I get this massive equity value. Again, they have such a high free cash flow margin. To me, they're very attractive. It's highly discounted. You can do a lot of things with cash. There's no secret that Warren Buffett likes insurance companies because they create all this cash, and then he likes them to begin with because they produce that cash. But companies like Met can buy into investments. Right now, bonds are doing really well. They can make a lot of money on bonds, treasuries, that kind of thing. And there's a lot of ways for Met to make money. And when I value the company based on earnings per share, using very low metrics like a PE of 12, a growth rate of 5, I get the stocks discounted by 44%. So overall, Met is a buy for me. I'm going to start buying the stock just because I've owned Met in the past. It's been a long time. And I just think the numbers are just too good. And it is an industry that I've made plenty of money in 2024. But it's not an industry or a sector like technology that's so high. Like it's really hard to buy NVIDIA stock, in my opinion, because it's so high. I don't think financial services has gotten that crazy, and especially companies like Met. They have really good fundamentals. So I'm going to be buying into Met and see how that goes. I think it'll be a good addition to my portfolio. And then I think that answers the question that Nitchix had. And Nitchix is, you're commenting Met has a free cash flow yield of 25%, exclamation point. I completely agree with your sentiment. And I completely agree that, that's just a really strong business. You look at how they've done for 5 years, right? Nice, consistent upward chart. They've had some pullbacks. It's just going to keep going up and to the right, in my opinion, because their fundamentals are so damn good. Their cash generation is phenomenal. And so I'm good. Let's look at their dividends and just kind of show one more thing. They're paying out 44% of their dividend, of their profitability. That's really good. And their buybacks, 6.67. It's really good. The shareholder yield measured by buybacks plus dividends, 9.23%. That's ridiculously good. That's very good. So, all right, Snoopy, your company's looking good, buddy. I'm a Snoopy fan. I like Snoopy. I don't think a lot of people dislike Snoopy. Snoopy's a good favorable icon.